I'm Howie Lim. This is Money Hacks by the Business Times. For years, Singapore equities have been dismissed as the safe, boring dividend play of the investment landscape. Yet beneath this conventional wisdom lies a market quietly undergoing a profound transformation, shifting from a reliance on predictable income to the pursuit of dynamic, untapped growth. Welcome to Money Hacks. I'm Howie Lim. So is the market finally breaking free from its long-standing reputation? And could it be the strategic pivot your portfolio's been missing? We're getting help from Eastspring Investments portfolio manager Daniel Lau today. Daniel, thanks for your time.
Thanks for inviting me, Howie.
Let's start with tackling that boring stereotype, if you will. Singapore's often been pigeonholed as a pure dividend market. How much of that's reality and how much is it an outdated stereotype that might be costing investors potential gains?
Yeah, actually, that's somewhat of a half-truth. It's true that Singapore is still a very dividend-focused market. But if you look at Singapore just as a return perspective, over the last 3 years, in fact,
we're not doing too bad, right?
Yeah, we have held up against a lot of the North Asian markets or even the S&P, at least on a one-year perspective for S&P. If you were to think of Singapore as just a boring dividend market, then you would have missed the entire rally over the last 3 years. I think a lot of that re-rating is not being appreciated by the market at this point in time. The Singapore equity market that we have seen today is not the same Singapore equity market we have seen 3 years ago. So what are the structural changes that we have seen? There is real money put into the system, invested in, Singapore-focused investment strategies. There are also
the EQDP,
the EQDP program. Yeah, I think that's something that, investors should be excited about. And, since the announcement of the EQDP program last year, we have seen real improvements in the market. Liquidity has improved. For SGX, they have seen almost a doubling of investable stocks. Stocks are trading more than 1 million a day in terms of average traded value. It's now hit about 70. I think SGX has target to hit like 250 to 300 over time. That's exciting. And secondly, I think research grants, for example, that's funding a lot of coverage of stocks that no one was talking about 3 years ago, uncovering a lot of opportunities in the small mid-cap space. This is tangible and this is real. And lastly, when you look at the recent initiatives, for example, to improve retail participation, SGX also mentioned that retail participation has increased over the last 1 or 2 years, and there's hope that it will continue to increase with initiatives such as reduced pot lot sizes or increasing retail access with just $1 investment. So I think these are tangible initiatives that will continue to drive the Singapore equity market going forward. So is it still boring? I don't think so.
Why do people call dividends boring anyway? What's boring about getting dividends, right?
Exactly.
But let's, Daniel, talk about the growth pivot then. There are new funds that explicitly marry income and growth. Why this specific sort of dual focus strategy? Why necessary now?
Yeah, I think traditionally, if you were to think about building a portfolio, you want to build a traditionally high-yield portfolio, right? And you think that high-yield portfolio tends to be more resilient. But I think in the current investment climate, it's very different because the geopolitical tension of the last few years, we have seen wild swings in both the stock market, the physical market, metals and commodities. We've also seen with the new Fed chair, it's increasingly difficult to project the rate trajectory from the Fed. If you think of building, say, traditionally a high yield dividend portfolio, you are essentially playing there's going to be a lower for longer rate environment. But who can have the conviction to say that interest rates is going to be lower for longer? And therefore, in this current climate, we think that it's better to have a more balanced approach, marrying both dividends and growth. Building a dividend portfolio allows you to ride through any market volatility during a risk-off environment. And at the same time, there's more research coverage in the small mid-cap space in Singapore, and we do see a lot of opportunities there that has structurally longer-term growth and actually gives you extra juice for your portfolio. So right now, a balanced approach in terms of dividends and income is an essential portfolio, especially when the investment climate is fairly demanding at this point in time.
Research covering the small and mid-cap, enough or not? I mean, for retail investors, that is, to uncover those diamonds in the rough, so to speak.
That's a very good point. It is very resource intensive because around
Resource or research intensive?
resource and research intensive,
okay.
right? Because to do research, I need to throw resources at it and really man hours at that. The stocks listed in the SGX, I think there's around 600 over stocks. Only around about 60% of that are not covered or only has one or two analysts covering that. So it's very limited in terms of information flow from all these companies. As an investor, then you actually need to put in more resources to do your primary research. You have to get your hands dirty and do the work yourself. For us to do that effectively, we've decided to actually increase the boots on the ground. We're going to kick more tires, and we actually essentially doubled our headcount in Singapore equities this year. We are spending a lot more time meeting with companies, we're talking to other competitors, we're talking to suppliers and customers. We're also engaging expert networks to sort of ramp up our knowledge on different industries and still leveraging off our sell-side colleagues to help us to ramp up on that coverage. I'm quite fortunate to be in a position where we have offices around Asia. I think we have 10 offices around Asia. And this is incrementally more important at this point in time because a lot of Singapore companies are no longer just focusing on our very small market. You need to go regional. They need to go different countries. And how do you do channel checks without local presence? So for us, it's just a phone call away. I can call my colleagues in Taiwan, in China, in Hong Kong, or Southeast Asia. And this is how we do channel checks and how we uncover some of the hidden opportunities embedded within the small mid-cap space. Also, if you think about SGX, what they're trying to do, they're not just trying to boost local companies. They're also trying to bring in overseas companies to get listed in Singapore, be it primary or secondary listings. And this channel check with our overseas colleagues does help us a lot in terms of uncovering these gems.
I want to talk about some of the rote advice that's often given to retail investors, one being diversify. But many of us are heavily weighted toward US tech. How do Singapore equities then realistically complement a US tech-heavy portfolio? And are they actually the diversifier people think they are?
Yeah, I think we actually did a study recently. We compared a hypothetical portfolio, 50% in Singapore equities and 50% in the S&P. And how does that land on the efficient frontier? How does it lower the risk and improve the returns? Actually, it's the most optimized portfolio if you do 50-50. So actually, it does improve your returns and lower your risk at the same time. US tech-heavy portfolio, it's very concentrated on one theme, the AI trade at this point in time. As we can see over the last few months, the AI trade has actually gotten some level of derating. It's really driven by the debate shifting from excitement to whether are we able to monetize all these CAPEX, amongst other factors. So if you think about Singapore equities, the index is actually very broad-based. The rally is also fairly broad-based as well. It's not just concentrated on a single sector. It's a broad-based rally across different sectors. And when you compare Singapore,
such as what, healthcare?
You've got of course you've still got banks, financial services. We've got construction. There's marine sector that's coming up. Of course, the AI trade is still quite relevant in Singapore, but a lot of them are outside of the STI. And it's a big part of our market. It is not the Singapore equity market. There are opportunities outside of the STI. If you think about Singapore as a broad-based, diversified investment destination, it does complement your high-octane US tech-heavy investments. It does lower their risks and improves the return at the same time.
Still to come, what about combating biases and the changing Singapore investable universe? More with Daniel from East Spring Investments in a moment.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region. With analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
Welcome back. Daniel, what about resilience versus reward? The recent white paper highlights Singapore's historic resilience. How do you convince an investor, though, to prioritize resilience when they're currently chasing explosive, high-octane growth that's seen in other global markets? I mean, the downs are just as quick, too. I get it.
Exactly. I think explosive growth is fantastic when the markets are rallying, but it's terrible when the markets are on the way
When they
down,
tank,
right?
yep.
And when you talk about resilience, people think, oh, it's boring. Resilience is boring. But, sometimes boring, it's great when it protects your portfolio on the way down. At the same time, I don't think resilience is an antithesis of returns. It actually protects you on the downside such that when the rally comes back, you actually can recover much faster than having a much higher octane portfolio, which is very volatile. For example, let's say if your high octane portfolio falls by 50%, you need to double to get back to where you were previously, right? Compared to having a more balanced portfolio, a more resilient portfolio at the bottom, some high octane stuff at the top, your recovery will be much faster compared to a high octane portfolio. An analogy I would like to give is like World Cup, right? You can't have a football team with 11 strikers. There's no one defending your goalpost. You cannot have also a team of 11 defenders. There's no one scoring a goal. You got to have a balanced view there. And this is where I think, you have to have a resilient portfolio, of course, with some high octane, exciting stuff as well.
Let's talk about information gap, though. There are some structural shifts happening with Singapore's investable universe, how the rallying sectors are outside of the STI, maybe healthcare, maybe the green economy. Do you believe the market's current valuation, though, fully reflects this transition, or is there that information gap?
Yeah, I think there's definitely an information gap. And I think that this information gap, I would classify that between local investors that, are starting to really understand more about the Singapore equity market because we are based here, right? Versus global allocators. If you think about Singapore as a proportion of global benchmark, it's very small. And therefore, as a market, global allocators tend to overlook this market overall. You don't really need to be in Singapore if you don't want to, right? You just need to be in the large markets in general. But I think what global allocators are missing, they think that Singapore is boring, it's just dividend market. But we kind of mentioned that there are growth out there. What they are also missing is that the structural drivers, real capital coming in, research grants, funding research that no one is talking about 3 years ago, and also increase in retail participation. I think a lot of the global allocators will start to realize that actually there's more than just dividends in Singapore. And that information gap will start to narrow. And in fact, some of our conversations recently does show that we're getting more inbound inquiries from global allocators from around the world asking us, hey, what's going on in Singapore? It's done so well. What are we missing? What is this EQDP program? What should we be looking at beyond just the banks and the REITs?
But what about for Mr. and Mrs. Tan here, who just love the banks, love their REITs, love their ETFs and such? How do we get them to go through that mental shift, if you will, to capture this new era of growth?
Yeah, there's definitely some education that we need to do and increase in awareness of the Singapore market beyond the STI. I think we need to shift our view from a dividend market for the STI or for the Singapore equity market. I wouldn't want to use STI because, as I mentioned, it's just a reflection. It's not the entire market. We should be thinking of Singapore equities as both dividend and growth. And how do we get exposure to growth? Growth is really a lot in the smaller mid-cap companies that are showing you very nice earnings growth momentum. They can actually potentially give you much better returns compared to your large cap stocks in the STI. At the same time, we need to be mindful that we cannot just blindly invest in all the small mid-cap names in Singapore. It is a space where information flow
they have the new 50 index. Can we do that?
We can, but I think ultimately the small mid-cap space is still has fairly limited information flow. I think in this space, what really rewards you is careful selection. You cannot just blindly invest in everything. There are stocks that will do very well, and there will be companies that will struggle in the next few years.
Couldn't we follow you guys, or
I think for the very busy retail investor, Mr. Tan and Mrs. Tan, if you've got a full-time job, you can't be possibly following all these small mid-cap companies like we do on a daily basis. I think it's best for us to invest in a portfolio or in a product that actually allows someone to do the homework for you, right? I'll do the selection for you. Don't worry about it. You still can have your STI stocks. You should have your STI stocks as your core, but having exposure to a small mid-cap space gives you that extra juice in your performance.
Thank you so much for your insights today, Daniel, for spending time with us as well.
Thanks, Howie.
Daniel Lau, Portfolio Manager, East Spring Investments. This has been Money Hacks by the Business Times. I'm Howie Lim.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.